up ahead. Affirmative 612.
Hey, if you're an American Airlines pilot and you just got this email in the last week or so, it is almost decision time for the new market-based cash balance plan. We work with a lot of pilots at other airlines that deal with these plans, and so we're very familiar with some of the pluses and minuses to who this is good for, who it's not good for, and just some of the pitfalls that you want to avoid when it comes to adopting this plan into your financial plan. So we're going to unpack that today. We're going to dive right in.
All right, welcome into the podcast. Thanks for hanging out with Scott and I here on the Wealthy Pilots podcast. And yeah, Scott, we got a lot to talk about this week, so let's go ahead and dive in and break this thing down.
The MBCB plan, this is new for American Airlines. So this episode is kind of tailored for those guys and gals. But, Delta has one of these plans right now. Some of the other airlines are looking at bringing them in as well. And so, in essence, what this market-based cash balance plan is it works as what I would call like a spillover for excess 401k contributions. So, 401k contributions come into the account in a variety of different ways. They can come in a pre-tax fashion, a post-tax fashion, a Roth fashion. They can come from the employer. They can come from the employee. They can come from profit sharing. But at the end of the day, the IRS puts a limit on what we're allowed to put into a 401k. Okay, so for the 401k contribution limit for 2025, it's $70,000 total, employee and employer. Now, there are catch-up contributions as well that happen for some of the guys over 50, so that number can flex up for them. But we'll just use that base planning scenario for this discussion. So in essence, when the contributions from all sources, profit sharing, employee, employer, hit that $70,000 limit, you have reached the excess or the cap at what the IRS is going to let you put in the 401k. Currently, like previously at Delta, but currently at American, what happens is as you earn more income, you're owed a 401k contribution amount on that earned income. That's part of their contract. But so I'm owed this from my employer, but the IRS puts a limit on what I can put in. So if I've hit that ceiling there, then that spillover contribution I'm owed just gets paid to me as additional payroll. And so it increases my taxable income. And, I'm not getting cheated out of the money, but it's a lot of these guys are in their highest earning years. And so, there can be an argument to be made like, man, if there was no 401k limit, I would want that money to continue to go into my 401k. It's a little bit more tax sheltered. It's tax deferred. It's this, it's that. And ultimately what happens for most guys is it shows up as a payroll item. And then most of them experience this phenomenon of feeling like they got a raise, right? Hey, I maxed my 401k out, and now I feel like I'm getting, a raise because the money that should have been going to my 401k from American is now going to my paycheck, which is kind of nice. However, that kind of serves us maybe well for today, but it doesn't necessarily serve us for our retirement plan, right? And so basically what these airlines have, kind of worked on is developing these. This is a version of what I would call executive compensation. So, pilot compensation many times is like executive compensation. So, a lot of our executives in these companies and other companies will get something called deferred compensation, where they can defer up to 25, sometimes 50% of their income into a separate account. That's somewhat how this works. Like Delta also just rolled out their non-qualified deferred compensation plan. They're the first to do that. It's different than how the market-based works. So the market-based is not something that I can choose to defer my comp. It's simply when I hit that IRS limit and then I get into those spillover contributions, I'm able to opt into this plan where now I can, instead of those going to my paycheck, I can choose to put them into this separate account.
So it's got like a hybrid feel to it, right?
It is a little bit of a hybrid kind of account. Now, when you log into Fidelity, it's still going to show up as a new account there. So they're going to keep track like, hey, each year these contributions went to this account because you hit your 401k contribution limit. And, what ultimately happens is it goes into that account. Now, American is going to manage that. They're going to hire a portfolio manager to manage that account. So that's one aspect of it, I would say, is probably a little bit of a downside or a drawback if I was like doing pros and cons of the plan. I mean, the big pro is I can defer taxes on that money if that's your goal. Where right now, when it gets above that $70,000 limit, it gets realized as taxable income, goes to my paycheck, and then I could choose to invest it there or I spend it. Most guys probably spend it. But ultimately, this plan allows me to take that money and actually move it over and defer it into a separate account. That account's going to be in Fidelity. It's going to say, American Air, AA Pilots, MBCB, something like that. And then that account balance will start to grow every year. It's not going to be huge because it's just going to be the spillover amount, but you don't have any investment control over that. Now that account is in your name. So if American Airlines went out of business, that is your money. It's in your Fidelity. It's your account. That's a little bit different than deferred comp as well. Deferred comp is actually, you're leaving it as a liability on the company's balance sheet that they're going to pay you later when you separate from the company. So deferred comp is a little bit more risky in that sense, I would say.
Gotcha. Okay. Well, before we get too much further into this, Scott, let's throw out a couple of quick information pieces. One of the reasons we're talking about this is it's a pretty tight window, right? So it looks like employees can opt in or opt out between November 24th, which was, just less than a week ago, through December the 15th, right? So, and there's two tier options, tier 1 and tier 2. So it's something that you may need to jump into relatively quickly if this is on the radar.
Absolutely. And I think, this, and I know you'll put my cell phone number in the show notes and stuff too.
Absolutely. Yeah. We'll have everything up there for.
We just went through this with a lot of the Delta guys last month. Like if you're getting this and you're like, man, I'm not 100%, just text me and we can hop on a call, for 5 or 10 minutes and talk about what applies to you and what's going on with your specific scenario. And then we can figure out, what probably makes a lot of good sense for you and then figure out if there's any other discussions to have. But
yeah,
I would say this plan is like, it's agnostic. It's not, the company's not screwing anybody. It's not necessarily good for you. It's not necessarily bad for you. It's just more so like, what are your goals? And so I know
to your point, to your point, the tier 1 is that MBCBP, right? That's that new thing. Tier 2 is basically just the status quo, right? It's the option to just stick with the previous structure. So
that's right.
So not too complicated, I suppose, as far as that goes.
Correct. But, at the end of the day, it's more so like, what am I trying to accomplish? And I know you guys are going to put that tax graphic I sent you up. And in that tax graphic, you can see there's 3 basic, kinds of money as far as the tax classification goes, how the IRS looks at it. We have taxable on the left here, pre-tax in the middle, and then after tax or Roth on the far right. So, this market-based cash balance plan is going to be another asset that we're putting in there in pre-tax. Okay. And so, again, if my options were, hey, I'm just going to look at this as a pay raise at the end of the year, and I just blow all the cash on whatever, and I don't continue to build wealth with it. Maybe we do want to look at leaving it in that pre-tax bucket so we can at least be building our retirement savings in a tax advantage way.
Okay.
I will tell you though, you talk to any 66-year-old recently retired pilot, or really 65 and 1 day year old recently retired pilot, and they're going to tell you, man, I wish I had more money out of that tax deferred bucket, because that pre-tax bucket gets huge. When you look at the company contributions, if you're putting your contributions in there, now this market-based cash balance plan, maybe some deferred comp if you're at one of the airlines that offers that, or if this comes to American down the road, that pre-tax bucket can get huge, and it leads to a lot of issues in retirement. They're first world problems, don't get me wrong. But this is something that creates a lot of issues in retirement. If you're trying to do any tax planning, you really pigeonhole yourself. And so one of the things that we do recommend guys take a look at is if we can get an account over on the left side here, some sort of joint brokerage account or something like that. And instead of pushing these excess contributions into a market-based plan that you have no investment control over, that generally means it's going to be invested much more conservatively than most of our guys are willing to invest, which means you're going to get lower returns typically. That's how those two things typically correlate. If we can, lean in and just have a little planning session to get intentional about this and open an account over there and think about what are we going to use that account for. We can build a really nice size brokerage account in that left-hand side of the chart on that taxable side, where when we get in retirement and we sell some of those assets off, we start to live off of the capital gains rate, which is much, much lower than the ordinary income rate in those higher brackets.
Oh, okay.
And what that does for us early in retirement, Mark, is it allows us to, again, if I'm living off of capital gains, that is not taxed as ordinary income. The IRS doesn't realize, I still have to pay some tax on it, but it's not income tax. So what it enables me to do is start to early in retirement, take some of that pre-tax money and do a Roth conversion from pre-tax over to Roth. And I can start to get a really good distribution of my assets in retirement. But I have to live off, I have to have a bucket over, I have to have a good bucket over in that pre-tax amount. I'm sorry, in that taxable amount, where I can live off of that and still have the lifestyle that I've worked hard to deliver in retirement, but look poor on paper. That's what we want early in retirement. I want you to, I want your check an account to feel rich, and I want the IRS to think you're poor. That's what but we got to start working on that now. We cannot continue to pile more and more and more into the pre-tax bucket and then show up in retirement and say, hey man, that's great. I got a $6 million 401k. And you're looking around like, well, shoot, everything I want to do with this money is a taxable event. Again, it's first world problems, but man, when you want to buy a house, when you want to buy a boat, when you want to take a trip, when you got to pay some medical bills, long-term care bills, whatever. I mean, that $6 million 401k is not $6 million. It's really like 4, maybe 3, you know what I mean? And that's what we're trying to look at, like lowest tax rate for my lifetime. And so if we can look at maybe doing some diversification across those other 2 tax buckets, that's where it really, if you want to be intentional and you want to show up at age 65 or earlier, if your goal is to retire earlier, and say, man, I'm really glad I have a diversified classification of my money and I'm not obsessing over just the gross dollar amount, that takes a little bit of planning now. And that's going to, I think, lead you to say, hey, should I really, join this plan or not? So I had a discussion with one of my American pilots this week and told him, okay, man, ultimately it's up to you. The company's not trying to screw you. It's a benefit. Like, this is a benefit they're offering you. And it's great that you can have a period to opt in or opt out. I think over at Delta, I'm pretty sure a lot of the newer guys now just automatically get opted in. And so it's great that you have the option, but he decided to opt out, and he's going to continue to fund that brokerage account and build that asset base. So, he's like 48, 17 years from now when he's retiring, he's like, man, we're going to have, a good 7-figure bucket plus bucket over there to plan with early in retirement.
Well, and again, some key takeaways here. It's a major update that could significantly impact pilots earning over $250,000, right? So it's the MBCBP. Really, I mean, they even put right on the thing, Scott, they put, due to its complexity, make sure you're talking with a financial professional, before you take in the action to kind of make sure it's aligning with your strategy. And that way you just understand what the specific options are. Again, tier 1, which is the MBCB, tier 2, status quo. That election needs to be done by December the 15th to ensure your 2026 benefits, again, align with your financial strategy. Any final thoughts or takeaways? And again, we will put all the contact information in the show description as well for you.
Yeah, no, that's good. I mean, and I'm going to include the plan document here too with the brochure and all that. So, I mean, I know the guys all got it in their email, but at least that way, it's here for everybody to be able to kind of listen and look. Again, this is one of those things that, like, it might seem small now, but this is one of those decisions you kind of look back on years later and say, either it's going to be one of the 2 things. Either I'm happy with the decision I made, or man, I wish I would have done some stuff different. So, you can kind of scenario plan, and it doesn't take long, man. It's like a 15-minute conversation. Do some scenario planning, take a little time to envision how things are going to shake out and how your lifestyle is going to look in retirement. And then you can make a confident decision now that you feel really confident you're going to look back and say, and that was a good call. So,
all right. Well, if you need help, again, Scott's here to help. with this conversation. He is the airline advisor. So we'll have all the links in the show descriptions below. Don't forget to subscribe to the podcast on Apple or Spotify, and of course right here on YouTube. And definitely have a conversation and get yourself onto the calendar, have a chat with Scott quickly, especially if this topic is important to you, because this is, I think today is the 4th that we're dropping this podcast. So depending on when you catch it, you might want to reach out to him ASAP. And we'll see you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.